welcome to Real Job Optional Freedom. Real estate can be complicated. Let an investor guide you. We are here to demystify the complex nature of real estate by getting you answers from professionals who are in the trenches so you can be the hero of your real freedom story. Welcome to Real Money, a weekly segment of the Real Freedom Podcast where we ask the most pressing real estate questions. Here today with my co-host Kevin Gilbert, and I'm Chris Bell. We are going to discuss everything real estate today. Not a structured call, but we are going to talk about multifamily investing. We're going to talk about what we're seeing in the market, interest rates rising. Is real estate still a good place to put money? Everything that we're seeing. And let's go ahead and kick it off. Kevin, what are you seeing out there?
I'm seeing a change in the market, right? We were talking earlier, we were talking about stocks are down, everything's down. Cash is a little down, but what's up? Real estate, right? So I love that. I think people drastically underestimate the power of real estate, right? It's not something where you can add units to a town overnight. Like, it takes some time. The cities often fight it, especially when you start talking about multifamily. Somebody's trying to put an apartment complex at the front of my neighborhood, and all the neighbors are in uproar that they're about to put this 4-story building in front of their place, right? So you get that across the country, and it creates this housing shortage. Like, you're just tightly packed in. So housing's at a premium for everybody, right? And it goes up. And I think everybody underestimates the power of that leverage, right? You got this asset that produces, people have to pay the rent, and then that comes up, and then you're able to leverage that asset. Stocks, typically you're just paying cash. There's not a lot of margin stuff on that. A lot of other investments, you're putting up 100% of the funds. And I think the fact that the government is willing to back it, and the banks are willing to back a mortgage on an asset like this, I think people just keep forgetting just what a difference that makes in your return. And anytime somebody's trying to compare returns from real estate versus, say, stocks, they're like, oh, stocks were up 10% over the last year, but real estate was up 3%. I'm like, well, that's just appreciation. That's not counting, the fact that you're getting dividends every month. That's not counting the tax benefits, because the government wants you to own real estate. The government doesn't want to be the one owning the real estate. They know that they suck at it, right? They want you to be the landlord, right? So you got all these benefits, and I think that's what we're seeing in the market is we're seeing a change, but real estate's still the place to be. So.
Yeah, I think one of the things that's really interesting to me, and I've done some research on this before, but you can kind of look at real estate and you go, well, hey, what does it cost a builder to build this property? And then you can say, hey, based on square footage, this is what it costs the builder to build the property. And let's just say, like right now, I think you can look it up on the National Home Builder website. They'll show you whether you're in the Southeast or Northeast or wherever you're at in the country, like what the average cost to build a home is. And if you look at that, and let's say the square footage price is $175 a square foot to build your average home, you can start looking in your area. And if you find properties that are, don't have a lot of deferred maintenance and that type of thing that are below that average, you're actually building in equity because, essentially if the house were to burn to the ground, it would cost more to build it back than what you paid for it. And I think sometimes we forget that real estate is this, it's a commodity, but it's like this package of commodities, because there's lumber that's a commodity. There's copper wire in the house that's a commodity. There's glass, which is ultimately sand, that's a commodity. There's aluminum for the windows, the wrapping, and there's all of these commodities that are packaged up in housing. And when you look traditionally over hundreds of years, in an inflationary environment, commodities are the things that go up in value. It doesn't mean they don't go down, but it definitely is, history repeats, or at least it rhymes. The commodities go up in price. So when you're seeing all this stuff and you're looking at, potentially a shorter supply of the housing market. You're looking at commodities do well in an inflationary environment. And then housing just so happens to be a packaged bundle of those commodities. And you can see what it cost a builder to build them. And then you can start looking in your area and see if you can find properties that are cheaper than that. But you have to keep in mind, just because you're finding something at, I don't know, say $100 a square foot, something crazy, well, you might need to replace the roof, replace all the windows, replace the HVAC, basically completely gut the place. So you have to take that stuff into account. But it starts to help you just gauge, like, hey, I'm buying equity. If somebody's renovated a property, and done everything to it, like some of the turnkey providers out there, and you're still getting it at a square footage price discount, it could be a really good deal as a long-term hold. So, I think that's some of the stuff that people have got to consider, when they're looking at this market and looking at everything.
I love that stuff. The ones that always surprise me on the commodity side is how strongly carpet is tied to oil prices. It's, that one always hits me in the face every once in a while. You're like, how much for carpet? Oh yeah, gas is up right now. So, yeah, I love this stuff. I was talking to somebody who bought a house the other day, and he's running his numbers, and he's out of pocket 9 grand, and he's expecting to net about $900 a month. And I'm like, that is not a normal deal. But I'm like, you're talking before depreciation, before all the other things that come with this stuff, before, principal pay down, everything. I'm like, that's 120% return. That's a rare one. That is not what I see on a daily basis, but man, every time you run into it, you want to do a little happy dance, right? So,
Yeah. I think what's really interesting about that, Kevin, is, you and I have been doing this for a long time. Well, not as long as some people, but, generally speaking, a long time.
we're old.
And, if you are in the game on a consistent basis, you will see those kind of amazing deals every once in a while. But really, at least my philosophy is, man, if I could just hit singles really consistently and not have this big risk tolerance where, like, it's gonna house of cards and blow up on me, that's where I want to be, man. If I could just get on base consistently, not risk everything that I've built over the years. And because when you lose or you go backwards, it's hard to start and get it all going again. So you really
Especially
want
the
to,
older you get. Yeah.
you really want to pay attention to your risk profile there. So it's really interesting to kind of see that and hear stories like that. And like you said, it's not the norm, but it doesn't mean it doesn't happen. And
Yeah.
when you're around a lot of real estate folks, you tend to hear people want to brag about their good ones, right?
Yeah.
But they're also not the people that are ultimately doing well over a long period of time are typically those people that have just continually hit singles, a double here and there, maybe, once in their career, they've got a home run or a grand slam, but
It's really a matter of volume, right? If you're buying 10 houses a year and you get one fantastic story, you're hitting about 10%. If you buy 10 in your lifetime and one's a knock it out of the ballpark thing, then yeah, those percentages kind of run true. But you're right. I remember a house I bought maybe 2.5 years ago. Let's call it late 2019. And I was not excited about this house. It was marginal, but I was adding one more to my portfolio, right? If this was my first house, I'd have probably just passed and been like, this is, you talk about the risk it all kind of stuff. And when they're marginal and they're going to be marginal for years to come, you're kind of like, I don't really want to get, it's not excited about it, right? Well, as you know, rent's gone up, valuations of houses have gone up. I mean, it's kind of been crazy awesome. a house I was not excited about. I didn't feel I was getting any equity. I felt like I was paying full price and just going to sit on it for 20 years, kind of thing. I think the mortgage had about 50, I think it was a 15-year mortgage. Um, so I was not excited about this one, but I was like, all right, I'll be glad I did it 15 years ago, provided everything goes great. Well, here we are 2.5 years later. I have over $100,000 of equity, and I think the rent's gone up about $300 on that thing. So you're getting a little cash flow now, whereas before it was kind of tight, right? And that was an awful deal that literally like debated it the whole time we're going up to close it. I'm like, what am I doing? Is this a dumb decision? So, you know, that is a great example of all the things that make real estate great, right? It's an inflation hedge. There's leverage. All these things that come into play really worked to my advantage on that one. And that was not a deal I would have like if a real estate student or a new person came with me, I'd be like, if this is your first house or your first 10, I don't know that I'd be doing that kind of deal. And yet it still turned out fantastic, right? So I almost feel like you don't need home runs in this business. What you need is to just be in the game, right?
Yeah, so I mean, we talked about this a little bit too, Kevin, as we talked about that kind of ladder of real estate folks, where it's the wholesaler, and then it's the guys that are doing subject to, it's the guys that are doing rehab and flips, and then you've got maybe some lease option folks in there. You've got your long-term buy and hold rental type investors. And you got kind of your retail buyers, and all up the chain of that ladder. People have this opportunity to make money and do really well. And what I was saying to you, Kevin, is basically you could be an investor, a long-term hold investor, and go into essentially any market. Look at all these "we buy houses" signs on every corner. Call them all up and basically tell these wholesalers you'll pay them more money than the next guy, because you don't want to flip it. You want to buy it, renovate it up to a rental standard, which is not the same as a retail sales standard, and basically hold on to it. And it gives you a lot of power. So essentially, you could go into a market, and if you had some cash to do buy and holds, you could find properties, and you could literally be buying equity from wholesalers, because you can pay more than the guys who are trying to flip the houses, because you don't have a margin that you've got to meet. You're not, quote unquote, living on what you're making on that flip and that kind of thing.
Yeah. So you talk about there's margin and there's money for everybody on that list, right? Right up to the retail buyer. And I think people like forget how that works. Like, I don't want to get into industry lingo or into the weeds, but you know, the wholesaler and the rehabber, they have time limits, right? If you're buying this and you're going to rent it and hold on to it for years, guess who's going to make the most money? And it's going to be the guy who's got the most patience, right? Um, Things that are tight for a rehabber, because you're talking about that standard, right? A rentals repair versus I'm going to sell this for top dollar repair are not the same. There's a number of times I go in a house and I'm like, I mean, these cabinets are not bad, but they got to go, right? But if it's going to be a rental, you're like, all right, well, these cabinets are going to get a fresh coat of paint. And it changes all your math, it changes all your numbers, right? So I do call those bandit signs, I do call those wholesalers, and I establish relationships with those guys. And I'm like, send me your inventory. I may not be able to buy it next week with cash, but I might be able to buy it if you can get me access and we can go through the whole mortgage process. And and they'll be like, well, not on this deal, but on this deal I can do that. On this deal I can. On this one I can. And you can find some great deals like that if you're okay with doing the repairs. I mean, I got to tell you, if you look 5, 10 years down the road, though, if you just bought it off MLS through a regular old agent paying full price for the house that's not the prettiest, maybe it's somebody selling a house that wasn't completely renovated. They just lived there for 5 years and moved out. Whatever. I got to tell you, the guy who owns the house the longest tends to win because of leverage, because of rents increasing and inflation hedges and all that.
Debt pay
It's just a win.
down,
Yeah, the debt pay down. I love it.
depreciation, like the tax advantages, absolutely. And one of the things I was thinking about this, Kevin, was, everybody's seeing these interest rates, these 30-year interest rates, they're, I don't know, basically pushing 6% right now. Everybody's saying the Fed is, going to push these things up to the moon, over the next, I don't know, by the end of the year kind of thing. And what I constantly have to remind myself is that we had some of the best interest rates probably in my lifetime over the last couple of years, down in the twos and the threes. And even now when everybody's, running for the hills, the 200-year average of a 30-year mortgage was the 5.25%. So we're hovering right around the 200-year average. So you should legitimately be able to make deals work at these interest rates. And it also reminds me of, guys that you and I both know that were investing in the early 70s, all through the 70s, and they were paying double-digit interest rates, and they were making real estate work for them back then. So it's possible.
It's all ratios, right? If the rent's this much, then you can pay that much. If the interest rate's that much, well, then you can only afford to pay a total price of whatever, fill in the blank. Um, it's a shifting, moving thing, and it's a constant change. But it always masses at the end of the day. You know what I love about the long-term average being about 5% is years ago when I looked into stocks, the long-term multiple tend to be about 20. So if a company made, $5, you didn't want to pay more than 20x of that, right? And I'm like, well, that puts you right about 5%. It's off interesting how that kind of stuff often works. I think this is really good stuff, and I think I talked to a lady yesterday. Well, yeah, it was yesterday, and she's moving. And I was talking to her about, subject two. We were talking about industry lingo, right? Subject two is buying a house, taking over the existing mortgage. And she had a 15-year-old mortgage, and her interest rate was 6.75. And I didn't ask her, but in my brain, I'm like, why didn't you refinance at some point over the past 10 years? And sometimes people feel like they don't have the income documents or whatever, to pull that off. But I remember just staring at her bank statement, go like, this is 15 years old, and she got a 6.75% interest rate, and there's nothing wrong with that. It's pretty normal. We're back to interest rates that are historical norms, right? So.
Absolutely, man. I think to your point, Kevin, this stuff is all math, and math um, doesn't care whether you're right or wrong. Math is math. So long as you're putting in good data in, you get good data out. And just a reminder, guys, if you're liking these conversations, you're liking the channel, please hit that like button, subscribe, uh, hit the bell so you get notified when we post new content. We greatly appreciate you guys joining us on this
And we'll
journey.
take questions, I guess, huh?
Absolutely. If you got any questions, put them down in the comments, and we would absolutely love to answer any questions you may have. Take care, guys.